The beautiful thing about real estate is there are so many different ways that you can, make money in real estate, that you can structure deals, and that you can achieve the goals that it is that you're, looking to achieve. And so for me, how I fell into a lot of when people say, what is your buy box? What's your strategy?
Yeah.
What do you like to focus on? Right. My answer is I am asset agnostic and I am market agnostic.
Okay.
I am an opportunistic buyer. I'm a value add buyer.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you on yours. How you doing today? This is Scott Kidd, the Yacht Captain Investor Podcast. I have a pleasure of having a friend of mine, Matt Atkinson, on the podcast. And how you doing today?
I'm doing good, brother. I'm not sailing and on a yacht like you are, but I'm doing pretty good.
Nice. It sounds like you got a big smile on your face, so you're doing well. For people that don't know about you, tell us a little bit about yourself.
Yeah, I got I'm based out of Northern California here in Sacramento, and I got started right out of college. Had this expensive piece of paper back in 2010, post financial crisis, when there was a lot of foreclosures here, kind of all throughout California. But I was interviewing at a bunch of places, for $30,000, $40,000 a year, and didn't really align with the goals and the income that, I was hoping for right out of college, which I'm sure, anybody coming out of college wants more than what they deserve, right? And I remember I came out of a job interview and was like, man, this isn't going to work. So I started looking at different paths, and my mom had actually started taking me to real estate investing seminars when I was like 12, 13, 14.
Nice.
And I'd always kind of had like real estate in the back of my head. So I went on Craigslist one day and I saw an ad for real estate mentor seeks real estate mentee. Little did I know that meant you're going to work a lot of hours for free in exchange for knowledge. And, that was how I started my real estate investing journey. I was helping a guy buy houses off of the courthouse steps, and I was project managing the flips, and I was dispositioning the flips and selling them. And I was watching, him clip 50, 60, 70 grand a house. I was making nothing, but I got a really, first frontline experience on real estate investing in single family homes. And so I was 21 at that time. And as I started going through the whole process, I was like, man, I can do this. But I was broke. I was living at home. I was, in a bunch of debt. And I remember one of my first mentors told me, you find a great deal, the money will find its way to the deal. And so I subscribed to that, ideology at 21 and said, all right, I got to find a great deal. So I was going around neighborhoods, tacking up bandit signs at 3, 4 in the morning. And after a couple hundred calls of, FUs and get your nasty sign out of my neighborhood, I got the one call that led me to the deal that changed my life and set me on course to become a real estate investor. And it was literally the neighborhood cat lady house. She had over 100 stray cats in her home. We found 2 dead raccoons underneath all the trash. It was a hoarder's house. I ended up, when all was said and done, profiting about $130,000, $125,000 on that house. And that was my big light bulb moment of, yeah, I'm not looking back. I'm going to become a real estate investor. And so fast forward, I, flipped a couple hundred houses over the next few years, mainly using other people's money and, kind of creative finance and capital and resourcefulness, became my focus and my strategy on how I was going to scale my operations. And then I quickly learned, I'm only as good as my next flip. So I need to really start thinking about how to generate some consistent passive income. So I started flipping 2, holding 1, flipping 2, holding 1, and slowly started building up a single family portfolio. And then, after a couple years of doing that, I realized, man, collecting $200 a door, all the time and energy and stress and the move outs and the turnovers and, the reinvestment back into the space, I'm, not really generating as much cash flow as I thought I would. I'm going to need a lot of single family houses and a lot of management and stress to put up with in order to hit the financial freedom goals that I was aiming for. And that's really when I started, shifting my attention and focus to look more at commercial real estate. And I'd kind of made this, thought around, I'd love to make $500,000 a year in passive income over the next decade. That was my goal. And so I really kind of reverse engineered, if I just wanted to buy one commercial property a year for the next 10 years, I need to find one property a year that nets me $50K a year when all's said and done. And if I can do that for 10 years straight, that was my model. And so that's ultimately what I subscribed to. And that led me to buying my first shopping center, led me into buying my first hotel, then my second, my third hotel. I've been in and out of a variety of different asset classes since then in terms of, medical office and retail shopping centers. I'm doing an 80,000 square foot shopping center redevelopment right now, working through closing on another hotel. So to, kind of sum that up, it's been a lot of failing forward moments, a lot of great learning lessons. Ultimately it's been something that has been an amazing ride and roller coaster that's allowed me to, really maximize the ROI and what I believe, I want for my life, and to leave it all out on the floor. And, real estate investing has been my vehicle for doing that.
That's great. I mean, so tell us a little bit about, what you're doing now. You mentioned hotels, and how did you get to like hotels? Because I know a lot of people, everyone has a different taste for everything. And some people only do single family homes. I have some friends that they have, we mostly focus on multifamily and some commercial real estate development now. And I have some friends that they have about 250 single family homes, and the multifamily and commercial stuff kind of scares them because it's really big. And I said, the 200 and something houses, that kind of scares me. It's like, I wouldn't know what to do, but they have all the systems in place and stuff. But tell us a little bit about how it got to the hotels and some of these other commercial properties, shopping centers for one, because a lot of people are afraid of retail and stuff right now with all the things going on.
Yeah, I mean, I always tell people, based on what your goals are and when you want to achieve them by, there's an asset class, there's a strategy, there is a vehicle for you to achieve that goal. And, the beautiful thing about real estate is there are so many different ways that you can, make money in real estate, that you can structure deals, and that you can achieve the goals that it is that you're, looking to achieve. And so for me, how I fell into a lot of when people say, what is your buy box? What's your strategy? Yeah. What do you like to focus on? Right. My answer is I am asset agnostic and I am market agnostic.
Okay.
I am an opportunistic buyer. I'm a value add buyer. And so based on understanding what goes into that strategy, the mechanics, the systems, the team, the timeline, the risks that go along with that, and ultimately what my goals are, those are, the strategies and kind of the investment subscriptions that I, abide by. That being said, I fell into my first shopping center, not because I thought it was the most aligned with my, buy box. It was, I didn't know any better. I felt like shopping centers were a great first opportunity to, kind of dip my toes in the water with real estate. It was something that was close to my house and my office, that I could touch. And I was able to fund that deal using 100% of other people's money. Nice. And that's ultimately what just got me in the game. Same thing on hotels. When people are like, oh, how did you go after the hotel? The hotel actually came to me. Because I am, pretty proactive on my social media with my podcast, and sharing what I'm looking for. I would just have people bringing me deals, consistently. And one person who followed me on Instagram, his pastor at his church, brought him the deal from a gal that was in his church that owned this hotel that was going to foreclosure up in Lake Tahoe. And so that is how I found out about this opportunity. And I went up and toured the hotel, and it was under distress and all that kind of stuff. And being a house flipper, I'm like, oh, I can do this. This is what I do. Little did I know that, buying a hotel was not just flipping a house, but it is a full-fledged operating business, a living, breathing organism that 24/7, 365, is an actual operating business that requires staff, that has, people inside of your asset coming and going at all times that need things. So I really, I always joke around. I got baptized on my first hotel into, the intensity of hospitality management. And that's also, there were a lot of challenges and learning lessons there. My first hotel I had launched 3 weeks prior to March of 2020.
Wow.
So in that time, as you can imagine, already stressed out by hotels, I was going, man, I'm going to go bankrupt. Or I am going to double down on this. I'm going to figure it out. I'm going to lean in. I was scrubbing toilets. I was helping my team do laundry, to turn over rooms. I was of the mindset that I'm going to do whatever it takes during this time. And this was obviously during COVID. It forced us to innovate, and we went heavy on automation and prop tech, and actually kind of pioneered some stuff in the small boutique hospitality space. And then that led me to buying my second hotel and my third hotel, really trying to get the scale of operations, of team, of the brand, things along those lines, which ended up paying off. In 2023, I packaged all of those hotels up with the operating company, and I sold that. And 1031 that into some other assets and opportunities. But in terms of how I kind of fell into most of my deals, it's usually deals that I know, just like the single family operator knows their systems, they know what levers to pull, they know the mechanics, they know the trapdoors now. As time has gone on and I've gotten more battle tested, built up a great team of people around me that obviously are way smarter, faster, and stronger than I am in the areas that I'm not. That's really given me the confidence to go, once you understand the mechanics of how commercial real estate work, mind you, each asset class has a few different nuances and operating, things that you need to understand. But in general, the levers that you pull drive, top line income, minimize and reduce expenses, drop as much net operating income down to the bottom line, and stabilize that net operating income to, maximize as much value as you possibly can out of that asset. It allows you, when you understand those mechanics, to start playing the game at a higher level. And so that's really what I started to learn and understand about commercial real estate in different asset classes. And I just felt that I had a much higher ROI on my time, on my skills, on my team, on my, my capital in commercial real estate that I could not get to the same magnitude in single family. And it allowed me to accelerate, hitting many of the milestones and goals that I had for myself much faster than I knew I was going to be able to do in the single family space. So that's ultimately what led me to some of the asset classes that I've been in.
Well, that's pretty interesting because, for a lot of people I've seen that have gotten into, a lot of commercial real estate in the last few years, they may not have been through COVID or global financial crisis. Explain to people what things you had to do, especially I know the hotel business during COVID, that there was a lot of things that happened there that were real big setbacks. So, and these were in California?
Yeah. Yep.
So
Yep.
How did you maintain the occupancy during COVID? Whereas a lot of people kind of really fell back and had got some really heavy hits during that time. What set you apart that got you over that hump?
Yeah, in any business, right, or in any challenge in life, I think it's, I think it's important to, give yourself the time and the space to have your little pity party, but it's got to be short, right? So I called it a 5-minute funeral. We, we kind of cried in the beer for a little bit. Can't believe this is happening. And then it's like, all right, well, what are you going to do about it? You can either lay down or you can lean into the challenge. And I know from previous, hardships and experiences that I've had, as long as it doesn't kill me, they've all made me stronger. And so that was the mindset that I subscribed to. And when all hotels were shutting down up there, I decided to stay open. That
Okay.
landed me on the front page of the news that, Millennial is, going against the governor's orders and putting the community in danger. And obviously, because of kind of the culture and the identity of Tahoe, it was more environmental focused and friendly and compliance and not doing that. And I said, if I'm going to go bankrupt, it's not because Gavin Newsom made me go bankrupt. I'm going to go bankrupt because I screwed things up, and it's at my own accord. So that forced me and my team to go back to the drawing board and said, how do we stay open? Not just by saying we're going to stay open, but how do we still find ways to work within compliance of a lot of the rules and laws that they were rolling out at that time with social distancing and, no face-to-face and this and that and all that. So that forced us to get into the prop tech space pretty heavily. So we automated everything from check-ins to concierge to housekeeping so we became, with all my hotels, one of the kind of the pioneers, at least up in the Tahoe region. And really, we've been interviewed in a lot of different publications for our tech stack and how we layered in a lot of technology to make things touchless and contactless in a lot of ways, with still not dropping the level of customer service and expectation that, customers have when they're traveling, right? So that was kind of a little vein that, we were never going to be a Ritz-Carlton. We were never going to be, one of these high touch, physical touch, hotels, but we could be a very amazing, digital and virtual hotel that gave you the same touch and feel without the physical person always being there. And so that's really where we started to play. And that's what led us down many different rabbit holes of how we can still create great experiences for people, leveraging the technology that is out there today. And that's ultimately what we ended up doing across all of the hotels and continuing to innovate and adapt. And so I think that's the biggest, thing there in general is in real estate, you're always going to have challenges. I mean, the one thing hotels taught me was, we always say every deal has an ordeal. And so something is always going to come up that's going to throw a wrench in your plans that you didn't plan for, that you didn't think about, that was a blind spot, that could throw off your model or your pro forma numbers, right? And the only thing you can do is just be extremely proactive in how you adapt your mindset, how quickly you pivot, and just focus on the solutions. And so that's ultimately what, we focus on a daily basis in my business, because every day, based on what asset class and what problems are coming up, there's always something new that we're having to address and lean in. And so, I think that's where hotels were one of the best blessings for me. Is I used to get worked up over, we'd have a dozen issues showing up every day and you're always on fire. And it's like, if this is how real estate investing is going to be, I'm going to be stressed out all the time. Or I can just say, this is how real estate investing is. Yeah. And we can learn to desensitize ourselves to the stress and just stay focused on a solutions-based mindset, attacking problems, building better SOPs and systems that allow us to mitigate those problems, make sure they don't happen again, build in safety nets, and you get better every iteration and every problem that comes up. And so that's ultimately been, especially in COVID, one of the biggest learning lessons there was, innovating led us to finding some really great stuff that actually, allowed us to capitalize and arbitrage some areas that we didn't initially see. But the problem was what actually led to an even better solution for our model. So things like that, I think, are really important in any real estate deal. Anytime a problem comes up, it's really an opportunity for growth that you can look at it as, happening for me or to me. And I always look at those kind of things of going, I'm going to be better and my team is going to be better. We just got to make sure that we're approaching and attacking this the right way with the right mindset and ultimately as quickly as we possibly can.
Okay. So I would say that the COVID then ended up being an opportunity for you, because I would imagine all the hotels that probably came online since then, you took that optimized touchless model and added it in, and have probably done it multiple times now. What would you say? Because I remember these things coming out during COVID, and there were a lot of things that, like, I remember, like QR codes and things like that. People were like, "Oh, that's not going to be a thing," or whatever. And the next thing you know, COVID hits, and they're everywhere. And so, like, checking in, I would imagine checking into the hotel, it was really, you probably didn't have somebody at the desk. You probably had a kiosk or something like that, where probably displaced the key or gave them a QR code or some way that they could just have an electronic lock into the room without really speaking to anyone, or they probably have a helpline if something went. You probably had a call center. That's really great and really innovative. And as far as like boutique hotels, explain that a little bit, because a lot of people might not know. I know there's, it probably means smaller, but it probably is under a certain amount of keys, because you guys go by keys and not doors. Explain a little bit about that.
Yeah, I mean, and to kind of button up your last question, right? We because we decided to do what we did, while I did catch a lot of heat and I did end up on the front of the paper, we also thrived significantly because of it. We stayed open, and I think this is always a good reminder of, just as there are going to be people who don't align with you and aren't your people, right? Mm-hmm. You're also going to, by taking a stand of who you are and what you believe in, attract the people who are aligned with that. And so that led us to finding our customer base in a way that I would have not found without doing that. And we actually, ended up outperforming the market in terms of occupancy because of that. But in terms of, the technology components and your question on that one was really how we set up a lot of that stuff and kind of rolled it out into the properties.
Yeah, like some of the processes and stuff, just, a couple of them, because I know that a lot of them were really innovative, like a lot of those things that just came out that have really actually made it a lot quicker, and for just a lot of other check-in processes, and the kiosks have become commonplace in a lot of other businesses as well.
Yes. Yeah.
Restaurants especially.
Yep. Yeah. And so, the technology side was obviously something that we were consistently looking and innovating and working with. The other side, to answer your question real quick on like what classifies a boutique hotel. A boutique hotel is any hotel that is unencumbered by a brand or management that, is kind of a corporatized brand, right? So your big flagged brands, the Hilton, the Hyatts, the Marriotts, your big national, international brands, those are, your corporate brands. They have a flag, their name, and they usually have an operating system and operating brand standards that you just have to work within. And a lot of people like that, right? They don't want to have to worry about all the extra stuff. They just want all the benefits of owning a hotel. And they know that those brands, the brand standards, the systems, the operating and the management underneath those flags are going to produce, relatively a specific result based on the operating history and, all of the experience that they have. The boutique side is any asset that is unflagged. And it could have a management company in place or not, but you're the driver of the brand, of the identity, of the, operational systems in a lot of ways. And it really gives you the freedom and the flexibility to create what you desire and what your vision is in that hotel. And oftentimes it's, there are boutique hotels that are over 100 keys, but generally it's going to be smaller, 50 and under key hotels. But again, it's more so around the flag and the management structure that would classify boutique versus, flag, that oftentimes people don't understand that distinction.
No, that's great. It's great explanation, because I've always wondered, and I've recently learned a lot more about hotels as we're developing some hotels and stuff. And I kind of compared a flagged hotel to kind of like a franchise type business where you have a set of rules, set of standards, and if you don't abide by it, they can take it, and and they can pull you out of it if need be and stuff like that. It's also, with a lot of people, it's brand management and too, because Marriott has a particular brand, and McDonald's has a particular brand that if you don't abide by those standards, then you're going to be out. They're either going to buy you out or shut you down or something like that. But that's a great way to look at it. So boutique hotels could be quite a bit larger, especially when you have some smaller operators with multiple hotels and multiple locations. And I would imagine you've probably bundled some of these together and sold some of them at times when you need to be. Or do you just buy and hold for a long period of time, or do your strategy mostly whenever you get to a certain stage with the business plan, like multifamily or other commercial real estate, you look to sell or refinance?
Personally, me, I'm not syndicating my assets, so I don't have the timeline and the investor kind of covenants that are really handcuffing me to make certain decisions and to abide by. And not that there's a right or a wrong answer here. I think for me, most of my stuff, and I'm 37 years old. I plan on doing this for the rest of my life. So to me, ultimately, I'm just looking at each one of my assets as kind of a chess piece on my chessboard. And depending on what the market is giving me, depending on what the deal is giving me and where they're at, whether that's in the market cycle, whether it's in the deal cycle, whether it's in my capital stack, all of those things weigh into what decisions I'm making next. And so like with the hotels, I ultimately wanted to build a portfolio of 10, 15 hotels up in Lake Tahoe and eventually package those up and sell them to private equity. But because of some, life events, because of one of my partners in the deal, what I ended up getting an offer that ultimately it wasn't an offer that I couldn't refuse, but it was an offer that at that time and what other chess pieces I had on my chessboard of real estate, it made sense for me to exit them. So I think it's always important to go into every deal with a clear vision and a clear game plan and business plan of what are you going to do with this deal, based on this pro forma and what this financial model looks like, how are you protecting your downside, and ultimately how are you going to execute and capture and actualize the numbers that you see here on this model. And depending on, what happened in the market over those years, there were certain potential headwinds that I saw coming that could have been a risk that I could have, to no pun intended to you, right? I could have, steered my ship into the unknown waters, and potentially I could have made more, or I could have, made a really decent amount of money, maybe a little bit less than what I could make, but ultimately I decided to take some chips off the table and exit those deals and redeploy that capital into other assets that I felt that I had other upside in and things like that. And most of these assets were already, I'd maximized the cash flow, we'd stabilized the operations team, we'd stabilized the brands. They were already kind of like the value add was complete, and therefore yes, I was missing out on some cash flow and yield by holding them longer, but the equity was there. And so I decided to cash out on those and redeploy that capital into other opportunities. So I'm a value add guy for the most part. However, now that I've generated some more wealth and grown my balance sheet, I'm not just going after all value add deals that have that risk, components to them. Now I'm starting to take some of my proceeds and roll them into boring triple net, type of deals that have a little bit more stable long-term leases and structures and national grade tenants and things like that. But then I'm still doing, right now, like I'm doing a 80,000 square foot value add shopping center deal where I'm, working through a build out with TJ Maxx as an anchor tenant. I'm building out, a couple other spaces for national and regional tenants, and that's a big risky deal. But I've also got kind of these safe, boring, long-term legacy assets that most likely I'll be holding for the long term just for generating yield and cash flow. And the other ones are more for like, man, how much can I force into this asset and get a big payday at the end of it? and not necessarily get too many quarters getting kicked out of the machine along the way, betting on the come on the back end, but I still got some good cash flow coming in on these other assets. So I think it all depends on everybody's individual situation, what their goals are, what their risk tolerance is, where they're starting, where they're trying to get to, and obviously strategies can adapt and change depending on what the market's giving you, what opportunities you have on your plate. So that's kind of how I look at things. Of like, now playing real life Monopoly gets pretty fun. At the same time, I think there's a time and a place for every deal, and depending on who the sponsor or the operator is, and what they're trying to achieve and what their investors are expecting from them, would kind of dictate how aggressive or safe you decide to get with your investment model and your strategy.
Yeah, so it seems like you have a short-term strategy, a mid-term, and a long-term strategy just for overall gains, and everything kind of slowly gets funneled into one of three of those buckets, and the short-term probably gets turned over and go into some of the long-term to pay off that, so you get the long-term cash flow and everything, so that it keeps everything moving, and everything kind of moves around to pay for itself, pay for each other. That's a great strategy, because I was told a long time ago when I first started in any kind of investing, a good friend of mine told me, always have a time and a purpose on the money that you're doing. If it's long-term money, like maybe it's your retirement, like your long-term portfolio, you may cash that out at some point, or you may give it to your kids or something like that. That's your 30-year money, or your short-term big value adds might be a couple of years, and you might turn it over and sell it, and then that goes into the bigger pot. So I think that's a great lesson for everybody to listen to, because you don't want to just be focused on one thing. Initially, you probably do need to focus on the one thing to get that going, but then once that's established, you can branch out into all these other things. And you spoke of boring triple net leases, but boring is the best strategy.
boring, steady Eddie. One of my early mentors always said, you don't go broke making money, even if it's less than what you would like. You're preserving capital, you're generating yields. And I think it all depends. Like my partner on my triple net medical office building that I've got, he's got a lot of money but not a lot of time. And his capital goals, he wants to generate a nice 7-8% return on his cash each year. He wanted to participate in some of the cost seg savings on the depreciation because he's a high income earner over here. Mm-hmm. And so he's not necessarily as focused on income. He'd like to see it grow, but he's not too concerned about the upside. He just wants safe, steady, growth on his income, participate in some of the tax advantages that can offset some of his W-2 income. And so that investor's goals, and often what I talk about, like suitability, right? Just because a deal looks good doesn't mean it's actually suitable and aligned with what you're really trying to accomplish. So I think it's really important to, look at every deal and go, based on what my goals are, based on what my risk tolerance is, based on what my timeline is, like, is this goal and the risks and the timeline associated with it and what my capital needs are going to be of me, is it actually suitable to what I'm trying to do, right? And so the guy who's partnered with me in this deal is going to be different than the guy who's partnered with me in my value add hotel deal. Right. And so I think that's something to always just keep in mind, is like, not every deal is created equal, nor is every investor. And so that's one of the things that, I like to focus on, when I'm talking with investors that want to invest in deals with me, is really understanding, like, what is their investor profile? Because I've kind of boiled it down to 5 different profiles that I've identified. Is you've got the passive income seeker. This is the person that, wants the cash flow without the stress. This is your standard LP, right? They just want to get into syndications, get into REITs, get into, something triple net, and they just want to collect a check, whether that's in a partnership, whether that's in a REIT, a syndication, you name it, right? Or they just want to own something like a Starbucks by themselves. Cool. Like, they're just looking for passive income, and they want it to be very minimally intensive from a management and a time perspective. The second profile is the value add enthusiast, right? Somebody that loves improving properties. You think small apartments, storage, retail positioning, things like that. They've got some time, got the ability to do it, maybe open to the risk. So the value add enthusiast, you got the diversified portfolio builder. That's someone who likes to kind of mix active and passive, and they like to balance income and appreciation across their assets. Then you've got what I just mentioned, the hands-off kind of high net worth investor. They're capital rich, time poor. They like to invest in funds or people like me, right, to go out and do the work for them and just, partner with them or clip those checks. And then the real estate entrepreneur, which is my identity, where I eat, sleep, and breathe commercial real estate all day, every day. People invest with me. This is my business. This is what I'll be doing for the rest of my life, right? And so deals, development, scaling, fund operators, things like that are the real estate entrepreneurs. So based on who you are, that's going to give you clarity and help you avoid wasted time, investing in deals that aren't aligned with what your goals are, investing in deals or people who are. And when you understand kind of your overall investor profile and some of the variables that go into that, that's a good way of kind of narrowing in, maybe what feels like a 5-lane free of like, do I invest here, here? What lane am I in, to like helping you identify like, here's my fast lane. This is what I can focus in. This is going to get me to where I want to go, get me to go there faster, more efficiently, more effectively. And so understanding that alignment and suitability, I think, is really important for investors, whether you're an active investor or a passive investor.
Yeah, that's a great point, because myself included, dealing with different investors and different assets, all things are not for all people. Everyone has a different risk profile, and right. It changes throughout your life. When you're younger, you probably want more of the cash flow, to build up and everything else. But like your investor you were just speaking of, he wants a certain amount of return, and he more wants the tax depreciation and cost segregation and stuff. Like with us doing these development deals, it's not really for the passive investor per se that just wants to do passive investing, because there's not really any cash flow for at least a year.
Yeah, there's no yield on their money, right?
There's no yield until, but it's for the people that want to park capital, because our focus is really the 2 or 3x multiple in 3 years, because they're all built to sell. And if it's someone that's looking for that, then that aligns with their interests. So, for me, I've actually told people that, other investors that have said, well, we want, I'm okay with getting that, but what's the cash flow like? I said, well, again, there's not going to be any for minimum 2 years, if there is any, because at 2 years you might be stabilized and built up, and then you might get some, but a lot of that's going to probably be built up in reserves to keep operations going. So you're really looking at just getting the money when it's sold. So if someone is okay with that, then that's fine. But
yep.
And to your point of the passive investor, that suits a lot of like professionals that just want to get that yield and build their career and stuff. It's a great way to do it, and it's kind of something that's becoming more open about, that people are talking about a lot more of these really passive investments, because myself, I'm active, so are you. You're active, and you're going to be active for a long time. It's really about what that person's needs are.
Yep.
When you're not looking at that, then you're really not looking at their best interest, because if it's not fitting their aligned interest, then you're not really suiting what they need.
I think that's something a lot of people miss, right? Is like, just because you have the opportunity to invest in a deal doesn't mean you should.
Yeah.
And really understanding the differences between each deal and how it's structured, I think, is really important to determining whether or not it actually suits what you're hoping for and wanting to achieve when you make those investments, right? Yeah. And especially over the course of the last, let's call it 5 years, the amount of people that were syndicating deals that had no business syndicating deals. And here's the thing, it might have been a good deal, but the operator or the sponsor was not a good operator or not an experienced operator, didn't have that track record of success, or hadn't been through a full deal cycle yet, or maybe the way they structured the deal, or the debt and the capital stack, the way they structured that put them in a bind when rates went up, or their mortgage was resetting, or all of a sudden the bank's calling them for new reserve covenants. And there's all these things that I think as an LP, it's really important. I always tell a lot of the investors who invest with me in my deals, and whether it's me or somebody else's deal, like, you should be asking these questions.
Yeah.
I've really narrowed it down to 7 key questions that I think LPs should be asking the sponsors of a deal. Number 1 is track record.
Yeah,
I want to know that this isn't your first, just because you're a doctor and you've got,
you're smart.
50 other doctors in your network that can stroke a $250,000 check, and you might have found a multifamily deal that, looks good on paper, doesn't mean you should be the sponsor and the operator of this deal, or that you should be raising money from these people. So what's your track record, number 1? Who's on your team? I always say, like, I'm not the fastest, smartest, or strongest, but I got badass, world-class people on my team that make me way stronger than I am on my own. So who's on your team is number 2. How do you communicate with investors? One of the biggest issues I've heard from people who have deals going south is, whether it's good, bad, or indifferent, you should be consistently communicating with your investors. They should know when to hear from you, what they're going to hear from you. And so I think communication is extremely key, especially when things aren't going according to plan, right? Number 4 is, how much skin in the game do you have, Mr. Sponsor? If it's somebody that's like, I found this great deal and you guys are going to fund everything and I have no skin in the game, that may or may not be an issue, but I think it's important for investors to know.
I know that, yes.
Number 5 would be, what's your exit strategy? Like, how am I going to get my money back? When am I going to get my money back? How are we going to achieve this goal that you're showing me these numbers, spit out at the back end? What are the fees and the deal structure? That might be the number 1 thing that LPs really struggle to understand, and they need to understand. I can't tell you how many people I've seen get into deals and the sponsors are feeing the deal to death, or the way they structured the deal really benefits them as the GP. And if there's any shift in anything, it's all being bared by the LPs, and there's no capital left, or there's no insulation or reserves left, right? And so fees and deal structure are extremely important. I saw a lot of people fee deals to death. And then, of course, can I talk to other investors, right? Like, trust what they're saying, but verify it. Make sure that they've got a track record of, people they can refer you to and can honestly and, candidly give you their experience and those insights. And just by those 7 questions alone, you'll know very quickly, based on how a sponsor answers them, whether you need to do a lot more digging, whether you need to run in the other direction, or whether you go, this is a pro. I'm going to work with this guy.
It's all about vetting the operator. Actually, over time, I came up with about 100 that I have that are kind of based on those 7 in a lot of details, which I kind of answer myself as I'm talking to the investor, because I invest as an LP as well, and because I like to be passive in other people's deals that I know, like, and trust. And the main thing, it's 100% about the operator. I did like that you mentioned the communication style, because how they communicate with you immediately and in the beginning is probably how they will communicate with you throughout. If they're dismissive, or they don't answer your call and they're not responsive, more than likely, if things go bad, you're not going to hear from them at all, and it will be a bad situation. And do the background checks, do the credit checks.
100%.
Ask them if you can speak to other investors that invested with you in the past, and if they don't want you to because of privacy or what have you, that's okay. But if they're a good operator, they probably have 1 or 2 people they'll say, go talk to John. He's been with me for 10 years. It
would be a red flag for me if they told me that they couldn't introduce me to anybody because of privacy.
That would be definitely, for privacy and all those things. And the feeing the deal to death was one thing that resonated with me, because I went to a whole bunch of online. How I learned really quickly was just watching people pitch these decks over and over again. I used to go to couple of them every week just because I wanted to see and learn more about the deals and stuff. And
Yep.
I that's one question I would always ask, like if they had skin in the game. And if they didn't have skin in the game, that was okay, because sometimes you get to that point, where you're property rich and cash poor, and maybe you have your other guys on your team putting in some money as well. But what I noticed for a lot of time between that period of 2020 to 2023, 24, if you ask them if there was skin in the game, it was important to me to see that their fees didn't match how much they were putting in. And I asked a couple of guys one time, I said, hey, are you putting any additional money in to the fees that you're charging? And they said yes. And I said, because the amount that you say you're putting in is exactly the same amount as the fees. I just want to make that clear. And then they kind of got a little standoffish at that point, and that was kind of a red flag for me. I didn't, because it was kind of a live webinar or what have you, I didn't call them out or badger them or anything. I said, but if you could explain that'd be great, because if that is what it is, your fees max what you're putting in, just please let us know that, so we're clear on that. And that's fine. I said it's fine with me, if as long as you disclose that and let us know, because I'd rather everything be on the up and up. That that happens. Sometimes you don't have it. You got 10 properties and they're cash flowing and stuff, but you don't have that money at that particular time. So you're raising the money. That's why you're raising money,
which is totally fine.
Yeah.
If it makes sense, and most importantly, you're transparent about it and you're upfront about it, and everybody's going into the deal eyes wide open. Cool, right?
Yeah.
Like, whether I've done deals, I've got one of my properties where I was in a cash poor position, but I had a great deal in my hands. And so before I decided I wanted to syndicate it or how I wanted to do it, I went to a guy that I knew, had a kind of a surplus of cash. And I said, hey, I've got this great deal. And ultimately, I'm, looking for a partner that's willing to put up the cash, and I'll pay you a 7% preferred return. And we'll, anything above and beyond your 7 pref on your capital in the deal, we split 50-50. Once I return all your capital, right, we split the equity on the back end 50-50. And he was like, that works for me. I'm good with that. He's like, I don't care if you don't have any money in on the deal. I understand the deal. I understand your game plan. I understand how you stress test it and mitigated as much of my risk. I'm totally fine with putting this much cash in the deal. I'm going to get my pref paid out first before you ever see a dime. And so as long as everybody's goals are aligned and you're transparent, cool. It doesn't matter how you put the deal together. And that's what I love about real estate, right? Is you can get, in commercial real estate, you can get as creative as the minds at the table are willing to get. And if you are all clear, you lay out all the cards on the table or all the puzzle pieces on the table, and based on how you put it together, all the parties that are looking at that puzzle put together go, yep, I'm on board with that. That works. I understand. Cool. It doesn't matter if one person's doing all the work or none of the work or half the work. So I just think that's an important thing for everybody to understand when they go into a deal, because at the end of the day, deals can go sideways, and it's always the stuff you don't talk about that ends up creating all the friction and the turmoil on the back end that you could have talked about on the front end.
There's that saying by, what is it, Mr. Rogers, if it's mentionable, it's manageable. And
there you go. I like that.
It's a really good one, and then there's also on the business side, if it's measurable, it's manageable.
Yes.
So, but that's a great point we brought up about, goes back to your point about structure. If you can structure the deal right to where it's amiable to both parties, you may not actually need to have money in the deal, like you just said. Because you had somebody that had the money, but they didn't want to operate the deal, but they were okay with how you were doing it. So you gave him, more money on the back end and everything. You gave him money up front until his money was paid back. So it showed, incentivized it for him to where both of you could get together and do that. And that's something that comes with a lot of experience, and what I think like speaks to your point of like knowing how the deal is structured, to where if it's going to be balanced towards you or balanced towards the the GP team, and if it's heavily weighted towards the GP team, you need to know that there's a reason why, or something like that. It like you said, it's all okay as long as it's transparent and all the cards are on the table, and we all know this is what we're doing. Because the executing the business plan, things like you were saying, there's always something that happens, and that's
Always.
life anyway. There's life anyway. Something happens that maybe weather event, or or just even COVID, or anything. And for me, I've always wanted to say, get to know the sponsor first before really talking about the numbers and stuff. And I invested with people that actually got to know me first, to kind of figure out where I was in my life and what needed to happen to kind of why this was a good fit for me. And I think that's something that the human touch, sometimes some people have treated it more like a sales thing than just kind of the pushing the sales on, like you can do this or not do this. And I think it's very important that the aligned interests, like you said, and for them to actually know who you are, and you have to know who they are. So do the background checks, do the checks. And if there are bad credit things or defaults on properties and stuff, if they can explain it and say, hey, yeah, that 2012 was a bad year for me, I went bankrupt, and if somebody says that, they explain that to me, and right now they're killing it. Okay, well, I probably give them a shot at it, because hey, they told me about that and told me why this happened. But if they try to cover it up and didn't say anything, you came up with it, and then they backstep, then that's a red flag. Like
a big red flag.
Big red flag. And there's no, that's all really great stuff, because investors, you really have to ask these questions, because it's your money. You're investing with these people, and if you don't really know who these people are, that's going to be, it's a lot riskier than you might.
Yeah. And it just in my opinion, as we all know, at the end of the day, there's good apples and bad apples in every industry, right? And so just like there's, bad financial planners, there's great financial planners. Just like there's great, real estate operators and syndicators, there's bad operators and syndicators, good doctors, bad doctors, you name it, right? So, I think I always go into everything with a healthy level of paranoia. And verifying and checking everything, and knowing that I want to be in this industry for the rest of my career. I've been in it for 15 years now. It takes 10, 15, 20, 30, 40 years to build a reputation. It takes one lie, one bad deal, one negligent, decision to completely ruin everything. And so, I just know that the best of the best align with the best of the best. And those are the people that I continue to want to surround myself with. One, because that's my bar and my standard that I want to be held to and at, but I also know that those are the people that I learn from, being in proximity and through osmosis. They force me to be better. They force me to elevate to higher standards. They force me to raise my own leadership lid, my own, lens in which I operate, and how I, attack deals, and what I do to not only achieve my goals, but to protect, downside and not going, backwards. So I think there's, so many different ways that you can look at and approach deals, but those are a lot of the, what we talked about, a lot of the main pillars and a lot of the main, boxes that should be checked, and some of the things that as an investor, whether you're, a GP and you're raising money, you should be able to answer all those questions, right? And build a story and a narrative and address those things. Or if you're an LP, those are the things that you want to ask and to dive into before you trust your hard-earned dollars to be shepherded by somebody that might be a con artist, or somebody that might be a complete killer, and you hit the jackpot. And I always say, like, I'm happy to be the horse for my jockey. I'm running lots of laps around this track. I got a lot of gas in my tank. So I'm not looking to, I want to make sure that just because you can saddle up and stroke the check doesn't mean that I want you to be an investor in my deal either. It's a two-way street, And so I think there's a lot of those kind of things that you just always want to make sure, just because 1 + 1 = 2 doesn't mean it's going to be successful. I'm looking for the relationships and the opportunities where 1 + 1 = 10. And we got a lot of room and margin and opportunity to, create an abundance-based relationship for all of us to win long term.
Yeah, it's all long-term, long-term relationships and everything for myself, going back to what you were saying about just surrounding yourself with great people. I remember when I was younger and I played a lot of sports, and just in any career or anything I was into, I always wanted to be on the best court or in the best, or surrounded by the best people, because I didn't want to be the best guy on the scrub court, because I didn't do it because I wanted to beat everybody. I did it because I wanted to be the best I could be.
Best.
And if I could hang on the big court, I didn't care if I was even just in for a couple minutes or whatever. Hey, I'm at the high level. I'm
100%.
with, and I'm going to keep getting better until maybe I am going to be one of the best and one of those things. And real estate and any kind of business, that's kind of what you have to do, because you have to constantly strive to be better as a person and to be better as a business person and in real estate, because you can't be a good steward of other people's capital if you're not your best.
Yep. I couldn't agree more with you. And I think, we're in a great season of opportunity right now. Personally, these are my favorite seasons, when you've got like the stale, challenging markets.
Yes.
These are the markets that I have found my best deals and opportunities in. I think we're in another window of that time where, when everybody's like
not
confused and sitting on the sidelines, and what do I do with my dry powder, and do I deploy it? Do I sit on it?
Yeah,
those are, in my opinion, the best times to get in, and in hindsight, oftentimes like, man, I wish I would have bought more in 2011 and 12 and 13.
Yeah, I wished I would have bought everything at 8, 9.
In sight, right?
The house across the street from me sold for $27,000. By the time I realized that, it was too late, because those were already gone. And I think you're exactly right, because all these times come and go. And, everyone seems to buy in when the frenzy happened. You saw it through the COVID a little bit after and everything. And then, like, a lot of those guys are hurting, but they've pulled back because maybe they lost money and stuff during that time. But, I've told them, hey, I'm sorry you lost money or things were bad for you, but right now is the time, and they say they're staying on the sidelines, but you can't win the game on the sidelines.
Yeah.
At the same point, to use a nautical reference, you can't catch the wave from the beach.
Yes.
You can only catch when you're in the water.
Yeah. I always tell people, spectators don't get paid. It's the players on the field the ones who are stepping into the batter's box. Do those people strike out? Absolutely. I mean, their batting average is what? And most of them aren't north of 250, 300. So and they're striking out a lot.
That's if you're good.
That's if you're world class, right?
Yeah.
So, I'm a big believer in, you just got to get into the batter's box. You got to get some reps. You got to see some pitches coming across the plate. You got to swing at some. You got to strike out. You got
to get on base by any means necessary, because it's proven on base percentages is what wins games. I mean, and
it's not just about hitting home runs and grand slams. Singles put points up on the board too. You do those enough, right?
I'll take a walk or hit by a pitch. That's fine by me.
Hey, as long as you
I got a chance to make it around.
As long as you're getting on base, I just and I think, with if you can make deals work in this market, in this challenging market, when things are great, you're going to be killing it, right? But I think right now, a lot of people are pausing. They're concerned. They've got these fears. But again, if you do the right due diligence, you have, the right model, you stress test it, and you look at all your downside, and there's a lot of ways that you can mitigate risk in your modeling and kind of bulletproofing your deal. Obviously not everything, but there's a lot of ways that you can. And you find a good deal with good fundamentals in a good market with a good team and a good plan. In a challenging market like this, you can absolutely crush it when the market is, doing great. And when the market is doing great, it's going to be harder to find deals, because everybody's going to be chasing frothy real estate deals, right? So I think right now is one of the best times. I mean, I'm closing on 2 deals right now that I've got insane seller finance terms on. The sellers were willing to get creative. They're in some pain and distress that is bringing their motivation levels to get creative with me. And I think those are, those opportunities I'm seeing that pretty consistently out there right now. And so you just got to lean in and know that sometimes you might have to do 5-10 times the amount of work right now to find that one great juicy deal. But as we both know, all it takes is one deal to completely change the trajectory of your financial future. And you can't discount that.
No, you really can. I think, like you're saying, it's the season of the operator. If you're in the game and you're looking and you're taking swings, you're going to get on base. It just might be a lot more swings, a lot more pitches, a lot more everything. But it'll show who the really great operators are, because a lot of them have dropped out.
100%.
I mean, this has been really great. So, I really appreciate you sharing your experience and everything, with me and taking the time to speak with me here, because you've given us a lot of really great tips for a lot of people from your experience and stuff. So if someone wanted to find out more about you and what you're doing, how would they get a hold of you, or what's the easiest way to catch you?
Yeah, one of the easiest ways, I think one thing that people always enjoy doing, and it's an easy way to connect with me or, get in my ecosystem, is if you text the word quiz to 844-447-1555, that'll send you the free investor quiz to kind of give you an idea of what your identity, your investor profile is. So that's always a fun, easy way.
I like that.
Or they can, on social media, my social handle is @officialmattier on all my channels. Mainly, I am putting out content on my podcast that I've been doing for 11 years now.
Awesome.
And the YouTube channel, where I put out a lot of commercial real estate content, investments, deal case studies, people like that from my mastermind group, lessons, things along those lines. That's an easy way to connect with me as well.
Well, thank you very much for that, because I really appreciate it. Connect with him if you want to find out more about what he's working on, or learn a lot more about commercial real estate in general, because he's got a wealth of knowledge, and I'm sure he's glad to share it with you.
Happy to. Thanks for having me on, Scott.
Yeah, I really appreciate it. This is the Yacht Captain Investor Podcast. Thanks again. And just as a reminder that investing in yourself is the best investment you could ever make. And thank you very much for watching. Please like and subscribe us and follow along. And thank you very much for joining us.